Welcome to another episode of the Portfolio Fix, a podcast with AAM. Today we're going to focus on commercial real estate and specifically commercial mortgage loans. My name is Greg Ortquist. I'm a portfolio manager at AAM. AAM recently announced an exciting partnership with Affinius Capital to provide commercial real estate solutions to our insurance clients. I'm joined today by Alex Rapoport, a portfolio manager with Affinius. Alex, it's great to have you on the podcast, and welcome.
Thank you, Greg. Great to be here.
Well, let me just start right in. Alex, what kind of loans are you looking at? What are you seeing today in the commercial mortgage loan market?
Yeah, for our commercial mortgage lending product, which is a fixed rate, non-recourse insurance company mortgage solution, we're seeing loans really across property types. Lots of appetite with borrowers, specifically in multifamily, industrial, self-storage, student housing, retail with the focus on grocery anchored. And, in today's market where there's been some positive tailwinds lately, treasuries have been dropping here of late because this is a fixed rate product where there's a credit spread over the loan term treasury. I think demand has been very, very good. Recently, we've had a lot of good inbound requests, and there's some seasonality in our business where we've just had a few of the big conferences of the year, and a lot of groups are eager to be borrowing, and those with insurance money and allocations are looking to get dollars out the door. So in today's market, I think things are looking very positive, even though rates are still higher than frankly things had looked over the last few years.
So, like in terms of property types, are you seeing newer properties? Are you seeing more refinancing? What's that mix?
It runs the gamut. Where we at Affinius, prefer the part of the market that we're in is Class A real estate. We generally favor newer product that's best in class in the market or submarket where it's located. Certainly there's mortgages maturing all the time and loans that are out for refinance. And some of that might be 30-year-old product. I mean, at Affinius, we really target newer product across any sort of property type. And as we do our underwriting, we focus over the life of the loan and then beyond, how will that product compete against its competitive set?
Do you give up a little bit on spread on that when you focus in on new properties versus a refurbished building?
The way that we try to approach the market is for a lot of our competitors, they're going to want to see many years of operating history. It's an easier underwrite that way. Affinius Capital not only does commercial mortgage loans, but we're a very large shop on the equity side, both for development and acquisitions. So I think we've got a good handle on rents and how we approach the market also from a comp standpoint. And we look very heavily at basis. So in many cases, if you come in, for example, to a multifamily loan early and try to catch the financing before it would go to the agencies, Fannie, Freddie, or other lenders, there's opportunities to get yield. So in many cases, you might think that if you're doing the highest quality real estate, you might have to go for the lowest spread. That's not always the case. And a lot of this is leverage point driven. We're typically in the market 55 to 60% loan to value. Certainly those with insurance capital, there's loans that are very low loan to value, 40, 50%. That's typically not where we're playing because we're a very relative value focused shop and we're looking for a strong yield over a comparable credit quality corporate bond and similar duration credit quality there too.
So what spread and yield are you targeting right now?
Today it's in the upper hundreds over treasuries, right around 185-ish. We'll go up a little higher than that. We've locked some business so far this year in the 200 plus context. But, in today's mortgage market, you have groups that are in the mid hundreds over, in some cases even tighter than that. We are always looking for a better return, again, from a relative value standpoint. We think the part of the market that we target, you're not really necessarily taking any more undue risk. It may just have to be a little bit more of a involved underwrite of the market, comps, basis, et cetera, rather than just purely looking at an asset in a vacuum, so to speak.
And then in terms of, I guess we've been in a couple from 2 years ago, we're at much higher rates now.
Right.
Maybe they've come down a little bit, but I think you had maybe indicated that borrowers were going a little bit shorter. Are we seeing Are we seeing longer term deals now, or are borrowers still waiting for rates to come back down and
Yeah, we
that
occasionally are seeing some longer term loan requests, but I think to your point, Greg, back when we were in a 1.5 or 2% 10-year treasury range, there you had a lot of savvy borrowers wanting to go as long as they could. In today's market, a lot of our inbounds are in the 3, 5, or 7-year space. We have done over the last 5 to 6 months. We've closed some 10+ year transactions. A lot of times those are more conservative borrowers, high net worth family offices, groups like that just want to put something to bed for a long period of time and not have to deal with refinance risk. But in today's market, most of the appetite is shorter term. And one of the benefits of these CMLs, as we call them, commercial mortgage loans, there is a degree of call protection. So, by nature, if you prepay early, there's a penalty that comes with that. To the underlying investor, this is why insurance companies like it, is that it's good for asset liability matching. And because of that call protection, you don't see a lot of borrowers today wanting to go out and borrow in that, 15, 20+ year space, because if rates ever get better or something changes with their business plan, there would be a penalty that would come with that, prepayment premium that would go to the lender.
So let's switch gears. There's been a lot of press with the office market. Large cities, we're just hearing of a lot of still trouble in that sector. Have you seen any improvement in office? Is that a sector that you guys consider? Or are you still sort of avoiding the inner city office?
Yeah, I mean, it's certainly been in the headlines now for the last few years. And I think even just at the beginning here of 2025, it continues to be top of mind. Broadly for office across our firm, we're not doing any new investments in our credit program. It's not to say that we wouldn't look at it. We will underwrite that from time to time. But I think to our portfolio performance and our track record, we have not originated an office loan since the COVID pandemic. We had one loan that closed just as COVID was coming on. That was a commitment that we honored before the pandemic. But as we've had opportunities come to us over the last number of years, we've looked very quickly at demand. We've looked at, where we see rents going, given that so many tenants now, they might renew their lease, but it's only for 40 or 50% of their original footprint. We'll look at those opportunities, but haven't felt like you're getting paid in the insurance company segment of the market for that sort of risk that you take on for doing that. And, we have done plenty of office over the years, but it's dwindled down in our book. Today, it's about 12% only of what we have at Affinius. We're very heavily focused on multifamily, industrial. We've done a lot in recent years, the last 6, 7 years in self-storage. Those asset types have ramped up in our CML portfolio, where office has been, really over the last 5 years now, steadily going down as a percentage of the overall portfolio.
Right. How about any geographic areas that you tend to favor? Midwest?
So much of our firm at Affinius, we're based here in Texas. There's been a lot of growth in the markets in Texas and in the Sun Belt broadly. We've seen that in our existing portfolio, not only in our loan book, but in assets that we own on the equity investment side of Affinius. I would say generally we've done a lot, up and down each coastline, but, in a lot of Midwestern markets or Sun Belt markets, we will certainly look at where there's been job growth, population growth. You've got to be careful in some of those submarkets, or as you really distill down, because some of those have been prone to overbuilding. In my backyard in Austin, Texas, there's been a lot of that in the multifamily space. So we're very cognizant of that. But I think it's a benefit of our firm. We've got 6 regional offices across the country, and we commonly have folks at Affinius out in these markets, meeting with relative, market participants and getting a viewpoint on supply and where rents are going. And that informs everything that we do in our underwriting.
How about in terms of demand for insurance companies? Are you seeing a lot of demand when you see the new issues?
I think allocations this year, at least being at some of the major conferences here to start the year, in the insurance company segment of the market, I haven't heard of too many firms that are looking to do less than what they did last year. I think allocations are generally up across the market. In the insurance company segment of the market, you have those with insurance company capital that will write $2 million loans. There's some very large firms that will go out and write $200 million loans. We're broadly in the $10 to $75 million segment of the market. So these are all institutional borrowers, high quality properties. But for the underlying insurance companies, some will do construction lending, some only do permanent loans. Everybody's sort of got their specific niche. I think as the year goes on, you're going to continue to see really strong relative value relative to corporate bonds. I know in the insurance space, private credit has been very popular over the last number of years. From our viewpoint, there's not necessarily the credit experience that you see in that asset class like you see in commercial real estates where, delinquencies, defaults, losses, over time versus corporate bonds have performed very well. And in other forms of private credit, at the end of the day here and what we're doing, we've got a hard asset as collateral. And that's why as long as you're underwriting the underlying physical real estate the right way, we think that even if there's, trouble in the market, you at the end of the day have got an asset and something that you can hang your hat on rather than being an unsecured creditor.
Cool. It seems like the industry's done a pretty good job, at least the ACLI data that we see. There hasn't been a lot of loss history within the CML portfolios. Would you make any prediction that we could see some additional losses here, particularly within office in the insurance sector in general?
Yeah, well, Greg, I mean, you're right. Historically, in the CML space for, the U.S. insurance market, there's been very strong returns with not significant losses. Obviously, the GFC was a big roadblock, but I've looked at ACLI data going back, 30 plus years. And I think over the last 10, things have been very steady. That being said, knowing where so many of our competitors have their office as a percent of the overall pie chart. And in many cases, there are groups that 25, 30, 35 plus percent. I think we've not seen the full pain that will be coming for those with office loans on the books. Some of those have been shorter term loan extensions, or there's been sort of a workout. I think for a lot of those that are particularly downtown office buildings where it's going to take a long time to maybe never for some of those values to truly correct, there will be more in terms of loan delinquencies that should be then eventually on some of those leading to greater losses. The degree of that is going to be hard to tell. And I think this has been stretched out over some period of time. But extensions and some groups are just going to want to simply get some of these loans off their books. You'll probably see more on the loan sale market. And that's been a trend over the last 12 to 18 months for sure. But our view is we think that's going to accelerate quite a bit in the next couple of years.
Great. Well, I want to thank you, Alex. I appreciate your time today and your expertise. And we look forward to a long partnership with Affinius and shared success in the commercial real estate market. Thank you, Alex.
We do as well, Greg. Yeah, thank you so much. Thank you for having me.
Okay, bye.